Jerome Kerviel was not a star trader recruited from one of France's elite grandees écoles. He grew up in Brittany, earned a finance degree from a regional university, and joined Societe Generale in 2000 in a back-office compliance role. That back-office experience turned out to be the foundation of everything that followed. He spent 5 years learning exactly which internal systems logged which trades, how hedge confirmations were matched, where reconciliation checks applied, and which gaps existed between the front office and the operations team. In 2005, he moved to the bank's Delta One desk, a unit that handled equity index derivatives, and began building positions in earnest. Delta One desks earn money through relatively modest, hedged trades rather than large directional bets. Kerviel's method was to take large directional long positions in European equity index futures, primarily on the Eurostoxx 50 and the DAX, and then disguise them by entering fictitious offsetting positions into the bank system. The fake hedges took several forms: forged emails purportedly confirming trades with external counterparties, fictitious forward contracts entered under real bank names but without any actual agreement from those banks, and deliberate timing of entries to fall just before internal audit checkpoints. Because the phantom hedges appeared on paper to cancel out the real positions, his reported net exposure stayed within authorized limits. Kerviel did not start at 50 billion euros. In 2005 and 2006, his unauthorized positions were in the tens of millions and, critically, they were often profitable. Those early gains reduced internal suspicion and reinforced his confidence in the strategy. A pivotal moment came in the summer of 2007 when early subprime fears pushed markets down. Kerviel had taken short positions, and according to later accounts of the case, he generated approximately 1.4 billion euros in profit on those trades. Rather than booking those gains and returning to authorized activity, he scaled the strategy further. By the end of 2007, SocGen's subsequent internal investigation concluded his accumulated hidden notional position in long European equity index futures had reached approximately 50 billion euros. Investigators and regulators later documented a pattern of missed signals. Eurex, the German-Swiss derivatives exchange, contacted Societe Generale with questions about large positions linked to Kerviel's book in November 2007. According to accounts that emerged during the legal proceedings, Kerviel produced a forged email to explain the position, and the inquiry was closed without escalation. Separately, the bank's own internal systems generated more than 70 alerts over Kerviel's trading career flagging limit breaches and anomalies. In each case, the alert was resolved, partly because Kerviel's back-office background allowed him to understand exactly what documentation each control required. The bank had multiple layers of oversight, but a person who understood how each individual layer functioned could satisfy them one by one without any single person ever seeing the full picture. On Friday, January 18, 2008, a query arrived from another bank about an unconfirmed trade that Societe Generale's operations team could not match in its own records. What began as a routine back-office discrepancy became an internal investigation that accelerated through Saturday and Sunday. By January 20th, senior management had established that a single trader held approximately 50 billion euros in unauthorized, unhedged long exposure to European equity futures at a moment when markets were already under strain from the emerging subprime crisis. The bank's board convened urgently. The decision reached was to liquidate the entire position as quickly as possible, beginning at the opening of European markets the following morning. Monday, January 21st, 2008 was Martin Luther King Day in the United States. American markets were closed, which meant the buyers who might ordinarily absorb large European selling were absent. Societe Generale, acting through intermediary brokers and under instructions not to disclose the reason for the selling, began liquidating Kerviel's positions in Eurostoxx 50 and DAX futures markets. The CAC 40 in Paris fell approximately 6.8% that day. Other European indices fell by comparable amounts. Selling continued through Tuesday, January 22nd, and was substantially complete by Wednesday, January 23rd. The total loss realized from unwinding the positions relative to the prices at which they had been accumulated came to approximately 4.9 billion euros according to SocGen's own subsequent disclosures. On January 22, 2008, as Societe Generale continued its 3-day liquidation, the Federal Open Market Committee held an unscheduled emergency conference call and voted to cut the federal funds rate by 75 basis points, from 4.25% to 3.5%. The Fed cited deteriorating global equity markets and mounting recession risk as the basis for the action. It was the first emergency intermeeting cut since September 2001 and one of the largest single rate reductions in many years. What the Fed did not know at the time, and what was not publicly disclosed until days later, was that a portion of those falling global markets was being driven by one institution mechanically selling down a 50 billion euro position. Some economists and market analysts have since written about the timing overlap between the SocGen unwind and the January 21st and 22 market declines. Though how much the unwind actually contributed to the Fed's decision remains a matter of debate rather than settled conclusion. On January 24, 2008, Societe Generale CEO Daniel Bouton held a press conference and disclosed the full situation. The bank reported a €4.9 billion trading loss from a single unauthorized position alongside separate write-downs related to subprime mortgage exposure. Kerviel had been dismissed and was being taken into custody by French authorities. The scale of the affair stunned the financial community. A trader whose annual salary was reported at roughly €100,000 had, for a period of months, held a position larger than the bank's entire market capitalization. French politicians called for investigations into the bank's oversight. Regulators in France and other jurisdictions opened parallel inquiries. Throughout his legal case, Kerviel argued that his supervisors were aware, or should have been aware, that he was generating profits well beyond what his authorized book could plausibly produce, and that the bank tolerated rule bending when it was profitable. He argued he was made a scapegoat once the trades turned into losses. Societe Generale and French prosecutors disputed this account. In October 2010, a Paris criminal court convicted Kerviel on charges of breach of trust, forgery, and unauthorized computer use, sentencing him to 3 years in prison with 2 years suspended and ordering repayment of the full €4.9 billion loss. A French appeals court in 2014 upheld the criminal conviction but modified the financial penalty, and subsequent proceedings further adjusted the restitution order. The question of how much, if anything, senior management knew was never fully resolved by the courts. France's banking regulator, the Commission bancaire, fined Societe Generale €4 million for failures of internal control, a penalty widely noted in the financial press as modest relative to the losses involved. More consequential were the structural changes that followed across the industry. Societe Generale overhauled its risk management and trade confirmation systems. Banks globally reviewed the operational risk that arises when traders carry back office knowledge and therefore understand reconciliation mechanics from the inside. The Basel Committee on Banking Supervision's subsequent work on operational risk capital incorporated the lesson that internal process knowledge can be used to navigate controls individually without any single checkpoint capturing the full exposure. Tighter trade authentication and confirmation requirements spread across major institutions as a direct result. The Kerviel affair fits a pattern that had appeared before in modern banking and has appeared since. The mechanisms in each case differ in detail, but several features recur. A trader with operational knowledge uses it to satisfy individual controls without any single oversight layer seeing the full exposure. Early unauthorized profits reduce internal scrutiny and enable further escalation. The position grows until concealment becomes impossible, and the forced unwind causes damage far beyond what any one control failure could have predicted. The recurring lesson from these episodes is not that banks operate without controls. It is that controls designed as a sequence of individual checkpoints can be navigated systematically by someone who understands how the overall system was built. For most people, the Kerviel affair is not a personal investing story. It is a structural one. It illustrates that the institutions holding ordinary deposits, managing pension assets, and providing market liquidity carry risks that go beyond the prices displayed on a screen. Operational risk, which regulators define as the risk of loss from inadequate internal processes, human error, or system failures, is embedded in every large institution and is far harder to observe or price than standard market risk. The January 2008 episode also demonstrates that large price moves in financial markets do not always reflect changes in economic fundamentals. On January 21st and 22, markets fell in substantial part because one institution had to sell an enormous quantity of futures quickly, for reasons entirely unrelated to the underlying earnings or economic outlook of the companies in those indices. Prices can be moved by mechanical necessity as much as by new information, and the two can look identical from the outside.